Good morning, everyone. My name is Joe Bloodgood. I am a partner with Boulay Financial Advisors. I want to welcome you today on behalf of Boulay. We're excited to bring this economic update to you that I'm confident you will find both enlightening and entertaining. A couple of housekeeping items as we get started. The web call is being recorded, so we will send a link to everyone. And then second, as you have questions along the way, please use the Q&A box on your screen to submit a question. We will gather those questions and have time at the end of the hour for any questions that we do receive. Many of you own or operate small businesses. You may be navigating retirement or income planning, or maybe just curious as to how your investment portfolio may be impacted by today's economic environment. Our time today should provide both historical context as well as points to consider moving forward. Boulay Financial Advisors views the economy and the markets through the lens of your personal financial plan and situation, and continually looks to help you make decisions that will improve your financial standing through a process we call Wealth Nav. With me today is our special guest, Dr. Anirban Basu. Anirban Basu is chairman and CEO of Sage Policy Group, an economic and policy consulting firm headquartered in Baltimore, Maryland, with an office in Orlando, Florida. The firm provides strategic analytical services to energy suppliers, law firms, medical systems, government agencies, and real estate developers, amongst others. Dr. Basu earned his bachelor's degree in foreign service at Georgetown University. He earned his master's in public policy from Harvard University's JFK School of Government and his master's in economics from the University of Maryland, College Park. His Juris Doctor was earned at the University of Maryland School of Law, and his doctoral work was completed at UMBC with a concentration in health economics. Please join me in giving a warm welcome to Dr. Basu.
Righto, thank you, Joe. And this slide makes it clear that Joe is very good looking. And I think that's an appropriate thing to say on a Valentine's Day. And unfortunately, the fact that he's sharing this slide with me makes him even better looking, which makes me sad, of course, but such is life. There's a reason why I pursued so much education. So in any case, let's get right to the economics. And this is about an economic update. And as Joe mentioned correctly, I will leave some time at the end of this hour, quite a bit of time actually, for Q&A. So please think about what questions you'd like to ask as I go through this material. My presentation today is entitled No Time to Buy. This is a James Bond themed presentation. You'll see that theming throughout the presentation, whether you like it or not. I hope you don't hate it, but it's firmly baked within the cake. And so again, happy Valentine's Day. Let's talk about the economy. Now, there are lots of places I could have begun this. We could begin with the discussion of Vladimir Putin and Ukraine. We could talk about oil prices. We could talk about the Federal Reserve. And we'll talk about a lot of these things, as it turns out. But I'm going to start out this story by talking about the specter of inflation. Let's talk about inflation. It's dominated, of course, the headlines. Inflation over the past year has been 007, 7.5%. And so where are we in that cycle? How will this continue? What are the factors at work? And in fact, here is a graph of consumer price, or the consumer price index. So you see that darker line there? That darker line there is the all items consumer price index, all the things we buy as consumers. And as I say, inflation, as you've heard, running at 7.5% between January of 2021 and January of 2022. Now, I don't know how many millennials are on this call, as it turns out, but there are probably some millennials out there who think that inflation, or thought that inflation was just 2%, right? Inflation is 2%. That's what it is. What's the big deal? Well, many of us who grew up during the 70s and into the early 80s know that that's not true necessarily, and certainly is not true now. Now, the lighter line there, the light blue line, is the all items less food and energy. So that's your core inflation rate. We economists like to do things like subtract out food and energy prices from measures like this, because those prices are not only volatile, but can be influenced by non-economic factors like geopolitics. For instance, Vladimir Putin knocking on the door of Ukraine, or Chinese jet fighters buzzing Taiwan, whatever it happens to be. And so we look for a pure measure of inflation, and well, that measure of inflation suggests that inflation running at around 6% over the past year, again, core inflation. So hot in terms of inflation. And this has caught many people by surprise, including people who should have known better because they influence monetary policy. In other words, they influence through their monetary policy making inflation. In fact, here's some statements, recent statements from the Federal Reserve. So if you look at the left-hand column here of statements, this first statement comes from the June 2021 Federal Open Market Committee meeting. Quote, inflation has risen, largely reflecting transitory factors. By July, the statement read, inflation has risen, largely reflecting transitory factors. By September, the statement had become, inflation is elevated, largely reflecting transitory factors. Now, September of 2021, it's not that long ago, it's 6 months ago. So as few as 6 months ago, that was the notion. It's transitory, we're aware of the inflation, but it's temporary, very temporary. Don't worry about it, it'll be gone soon. Then by November, the statement really starts to transition in earnest. Inflation is elevated, largely reflecting factors that are expected to be transitory, but the word transitory is still there. And again, this is November now. So this is now roughly 3 months ago. And it is still the case that the notion is this is transitory, and of course it is. But the point is the definition of transitory has been stretched. By December of 2021, now I'm looking at the upper part of the right-hand column, the statement is completely modified. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. What's missing there, the word transitory, of course. That was put to bed. Now, the subsequent statement was made by our Federal Reserve Chairman, Jerome Powell, also the Federal Open Market Committee Chair, who said, quote, these problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% long-run goal and will likely continue to do so well into next year, close quote. Well, this is next year. And so the Federal Reserve is telling you what? Expect more inflation well above 2% this year. And so what has the Federal Reserve done? It has pivoted completely. And now the discussion is not about whether or not the Federal Reserve will raise rates in March, meaning next month, but whether they will raise rates 25 basis points or 50 basis points. Now I'm still in the 25 basis point camp, as it turns out, but the typical economist expects that the Federal Reserve will raise rates sometime between 4 and 7 times this year. So interest rates are headed higher. We now have a 10-year Treasury yield right now yielding 2.019% as I'm speaking to you. Let's call it 2.02% for kicks. But we're basically back at July of 2019 10-year yields. In some sense, if you look at the 2-year yield and the 10-year yield, the pandemic is over. We're back to rates that existed pre-pandemic. In any case, we'll talk more about this. Now, again, the reason I would say to you that the Federal Reserve policymakers should have known better is because they influence inflation. They do that through their monetary policymaking, including, of course, by having some influence over U.S. money supply, which here is graphed back to 1959. Now, look at the right side of the slide. You can see how much money supply has expanded over the course of the pandemic. Now, I know it's Monday. It's Monday morning for you, for instance, those of you who are in Minnesota. Right now, it's still Monday morning. For me, it's past noon here in Baltimore. So I really shouldn't do this, what I'm about to do. I want to be invited back by Boulay Financial to speak to key stakeholders like you, but I'm about to do something that pretty much ensures that Boulay will never have me back. I'm going to talk about the quantity equation in economics, also known as the equation of exchange, which is what I call that. I call it the equation of exchange because that's just much more attractive. In any case, the equation goes thusly: M times V equals P times Y. You could write it down if you'd like. M times V equals P times Y. Now, what's M? That's money supply. That's money supply, and that's what I've graphed for you here. What's V? The velocity of money. So let's say you've got a $10 bill in your pocket. That $10 is going to circulate through the economy several times this year. And that pace of circulation is the velocity of money. So the left-hand side of that equation, M times V, is how much money is in the economy to finance transactions. Okay, M times V. Now, the equation again is M times V equals P times Y. What's P? P is the aggregate price level. It's what things cost in the economy. Times Y, what's Y? It's output. Y is output, which we measure in this country as gross domestic product. So the amount of money in the economy equals what's available to be purchased. No? P times Y. P times Y is what's available to be purchased, goods and services, and that equals the money side of the economy. Okay, now let's have some more fun here. Shall we on this Monday morning? Let's take the logarithm of that equation. So now the equation becomes percentage change M plus percentage change V equals percentage change P plus percentage change Y. Now what's percentage change M? So if M is money supply, percentage change in M is the change in the money supply, which is sort of what I've got for you here. Plus percentage change V, what's that? Well, V is the velocity of money. So the percentage change V is percentage change in the velocity of money, but V for our purposes today is deemed to be a constant, and it is in fact over a short period of time. And so what's the derivative or the percentage change of a constant? It's 0, so throw that out of the equation. Okay, so on the left-hand side of the equation is percentage change M. Are you having fun yet? I think you are. So left side of the equation is percentage change M, growth in money supply or change in money supply equals percentage change P. Well, what's percentage change P? P is the price level, so the percentage change in P is inflation. That's inflation, which is running 7.5% over the past year based on the CPI that I just showed you, okay? Plus percentage change Y. What's percentage change Y? Well, if Y is output, economic output, percentage change Y is economic growth. But here's the issue. So when you increase money supply, two things can happen. Either inflation gets hotter and or output grows faster. But here's the problem. We have a shortage of 80,000 truck drivers in this country. We don't have enough workers generally. There have been global supply chain disruptions. Right? There continue to be. And so output growth has been constrained by all those supply side factors. So when money supply was increased, what took the burden of that on disproportionately? It was price. And so the same people who have been telling you it's transitory, baby, are the same people who should have known better because they have some control over this and they know the quantity equation or equation of exchange. Okay, now, please don't get me wrong. The money supply growth was not the only factor that has caused inflation. We have had supply chain disruptions. This is US manufacturers' unfilled orders. So you see the gray vertical stripe there? That's the recession period, okay? Early 2020. It might surprise you to learn that coming into the pandemic period, we actually had an elevated level of unfilled orders. But that wasn't a problem. Why? Because the economy was red hot. You know, we had cut corporate taxes in this country in 2017, for instance. The economy was still gaining momentum. And so before the pandemic, the notion was the global supply chain would rise up to meet that demand. We'd have a crescendo of transactional volume as demand met supply. The economy would take off. 2020 would be a fine year for the economy. Pandemic hits. We shut down the economy. Many companies, including auto manufacturers, not only shuttered their plants, they stopped ordering parts and components like semiconductors. All of a sudden, the economy gets turned back on, but the supply side of the global economy is not ready to deal with that. Well, that's inflationary. And we're back to a period of very, very elevated unfilled orders, but we're in the middle of Omicron still. And I understand that Omicron is fading, yes. Nonetheless, here we are with these supply chain disruptions. And so if these orders continue to go unfilled, there's scarcity, and that scarcity is associated with inflation. So again, money supply increase, supply chain disruptions because of waves of the virus, all these things have contributed to this expanded inflationary pressure, but that's not where the story ends. Because of course, one of the other aspects of economic life is just the sharpness of the rebound in economic activity. This is quarterly change in US gross domestic product. It's for your eyes only because you're the only ones here. So this slide is for you. Now there's two vertical axes here, left-hand axis and the right-hand axis. The blue colored bars here are indexed to the left-hand vertical axis. The red colored bars are indexed to the right-hand vertical axis. Now, if you read from left to right, the last blue colored bar here is the fourth quarter of 2019, the last pre-shutdown quarter for the US economy. And of course, we had momentum coming into 2020. This is a nation that added jobs in January of 2020, added 289,000 jobs in February of 2020, shuts down the economy in March. So that March of 2020 is encompassed in that first quarter of 2020. And in fact, reading from left to right, that is your first red colored bar. And despite the fact that we had that early quarter economic momentum, the last 3 weeks of March are so horrific in 2020 that it takes the entire quarter down with it statistically, during the first quarter of 2020, the US economy shrinks 5% on an annualized basis. Now, that would be big news by itself. For instance, during the fourth quarter of 2008, which had been the worst quarter of our economic lives, the US economy shrinks 8.4% on an annualized basis. So negative 5% print is a big deal. Unfortunately, this time around, it was merely the appetizer. For during the second quarter of 2020, the US economy shrinks 31.4% on an annualized basis. That's that red bar that you see sinking toward the south of the slide. That's that second quarter of 2020. That was the worst of it. And around that time, a furious debate breaks out in the economics community. What would the initial phase of recovery look like? Would it be U-shaped, L-shaped, Nike swoosh, check mark, square root, hockey stick? It was a straight up V. For during the third quarter of 2020, the US economy bounced back, growing 33.4% on an annualized basis. And growth since that time, generally speaking, has been quite rapid. So in the midst of these supply chain disruptions, we've had rapid rebound in economic demand. And the supply chain has not been able to keep up, and so that is inflationary. But even that is not sufficient explanation, along with money supply and supply chain disruptions, to fully explain inflation. There's at least one other major factor at work here, and that's labor market dynamics. So you probably heard this, but recent survey data indicate that America is home to 10.9 million available unfilled jobs. In December, we only had about 58 unemployed people for every 100 job openings. Right? 2 job openings nearly for every unemployed person. That's inflationary. And you talk to restaurateurs, hoteliers, others, what's the issue for them? Their principal challenge right now, it's not demand for goods and services, generally speaking. Demand for goods and services is pretty high. I'll show you data on that later on in the presentation. The issue is the supply side. Where do I find the workers to satisfy that demand? And I must tell you, some of us may have actually accepted a lower quality of service, right? Whether from airlines or restaurants or whatever it happens to be, which maybe we just expect to wait longer in check-in lines at hotels. We know that there is a shortage of workers. Well, of course, if there's a lot of demand for workers and not enough workers to fill available unfilled jobs, that's inflationary, because that would tend to drive wages higher. And wages are up by about 5% over the past year, hourly wages. You know, part of the story here, of course, is the transformation of America. I mean, this is the US labor force participation rate. It's a proportion of adults, working age adults, who are in the labor force. And it's bounced back to a degree, but it was 63.4% coming into the pandemic. By the worst of the pandemic, it's at 60.2%. The latest reading, which is January of 2022, toward the very right of the slide, it's 62.2%. But one of the things that we see is that a lot of people have not come back to the workforce. And among that group are baby boomers who retired earlier than anticipated, who retired earlier than even they anticipated, for a variety of reasons, sometimes very positive reasons. Their stock market portfolio took off, their home became more valuable, and all of a sudden they had the financial wherewithal to retire. But many other people retired for other reasons, less positive reasons. So we just don't have the labor force that we once did. Now the labor force is coming back, and I would say that part of the growth story for 2022 is that more workers are going to come back into the workforce this year. Why is that? They've got bills to pay. And the stimulus packages are in the rearview mirror. And please do not think that Boulay Financial invited a guest who's happy about inflation or the fact that people can't pay their bills. I'm not saying that at all. It gives me no joy to say that. But what I am saying is that inflationary pressure, whether in the form of higher energy bills or other bills, food prices, will likely induce some people who otherwise might have just been able to stay out of the workforce to rejoin the workforce. And I would say to you that the labor force participation rate will be around 62.6% or 62.7% by the end of the year. Now, there's something else here that's inflationary. We have seen some pretty poor productivity growth in recent quarters. I think one of the reasons for that is that a lot of baby boomers retired early. In many cases, baby boomers have been our most productive workers. For instance, in fields like construction and manufacturing, a lot of baby boomers were exposed to shop class. And shop class was typically taught in high school by someone with enormous arms, wearing a Rush t-shirt and driving a Trans Am, if you remember. At least that's my recollection. And these baby boomers, therefore, acquired a love for work with heavy equipment early in life. They went into segments like construction, manufacturing, the skilled trades with purpose, and they've been enormously productive. But as that generation heads into retirement, we're left with younger workers to try to fill those available jobs. And so we have a shortage of welders, a shortage of mechanics, a shortage of pipe fitters and plumbers, electricians, so on and so forth. All of that's inflationary. And so you can see that here in the employment cost index for private sector workers, 6 years of data graphed here. Now you see that darker blue colored line there, that's the growth in wages and salaries, as I say, 5%. By the way, a lot of Americans will point out to you and point out to me that, yeah, my wages are growing faster than they've ever grown during my career, but I'm still falling behind. And they're right. Because if wages are growing 5%, but inflation is 7.5%, they're right. In real terms, they got a pay cut. Now, the light blue line there, that's the growth in benefit costs, and they have not grown as quickly. So one of the things that some employers might be doing is, well, I've got to pay you more in terms of your hourly wage, or I'm going to pay you more in terms of your salary. I'm going to try to cut back a little bit, at least, on benefits, or at least the growth in the cost of the benefits I pay to you. And then the red line, the sandwich line there, is overall growth in compensation, but it's very rapid. And that's part of the inflationary story. So labor market dynamics clearly play a part. And, again, the fact that it's been so difficult to get workers to come back to the labor force for various reasons, right? Fear of infection, the fact that they've had maybe a financial cushion thanks to stimulus payments, or, the stock market booming, whatever it happens to be. The fact that many Americans prefer to work remotely. In a recent survey of more than 3,000 Americans found that 68% of those people who were surveyed would prefer to work remotely. And most of them also thought that if any employer tried to get people back into the office 5 days a week, that they would lose a lot of their employees. There's been a sea change in how we view work. And so that's led to an inconsistency in terms of job growth. So this is net change in US jobs, 20 years of data here. Again, the blue color bars index to the left-hand axis, like that GDP slide earlier, the red color bars to the right. Let me focus on the right of the slide, though. Job growth in recent months has been inconsistent, but in January, we got a really good jobs report, 467,000 jobs added, which is consistent with my notion that this higher inflation and the fact that people have bills to pay that are getting more difficult to pay, again, because the stimulus checks are behind us increasingly, and because inflation is with us, that they are rejoining the workforce and that we're starting to see some faster job growth. And indeed, the latest jobs report also brought upward revisions to the November and December 2021 data. Again, I think there's a momentum here in the economy. There's a momentum in the labor force. Not saying that inflation is going to go away anytime soon, but it seems to me that one of the growth aspects or elements of growth in 2022 is that, in fact, more people rejoin the workforce. Now, in some sense, this shouldn't be happening at all, this labor shortage or skill shortage. And why do I say that? It's because if you compare February of 2020 employment, which is what I'm doing for you here, February 2020 employment, February of 2020 was the last shutdown or pre-shutdown month in America. January of 2022 is the last month for which we have data. So this is basically the pandemic period here. We're down as a nation 2.9 million jobs. And these horizontal bars represent the number of jobs lost by each of these categories. So what I'm trying to say here is that the category called leisure and hospitality, which is mostly your restaurant worker and your hotel worker, is down nearly 1.8 million jobs. And yet you speak to any restaurateur and they will tell you, where are my workers? Why can't I not staff up fully? Why can't I maintain regular operating hours? Even McDonald's in December cut back hours at its stores by 10% because they couldn't find enough workers to fully staff up. Now, some segments have added jobs over the course of the pandemic, the last 2 years. At the very bottom, you see the professional business services up 500,000 jobs. Why is that? It's not necessarily because professional services offers more job openings, relatively speaking, than other industries. It's because professional services offers the opportunity for people to work remotely in many instances. And that's where a lot of people want to do. They want to stay at home. They don't want to go into work. They don't like their colleagues. What's the most awkward moment of the year at work? It's the holiday party, right? Especially because the spouses are there. So in any case, things have changed, and there's a permanence to some of this change. You see the category above that, trade, transportation, and utilities? That's your supply chain. That's retail trade, wholesale trade, transportation, and utilities. That includes Jeff Bezos and Amazon. Right? That's the e-commerce revolution is embodied within that category. It's adding jobs. So Jeff Bezos had a good year last year, not romantically, but in terms of adding a couple 100,000 associates, hiring 500,000 associates the year before that. So some of these segments have an easier time recruiting than others. Now, Minnesota Now, I know not all of you are from Minnesota, but some of you are, many of you are. Many of you are a very fabulously beautiful state. It says non-farm employment because that's the way the data come to us from the government. February 2020 versus December of 2021. So the January data are not yet available at the subnational level. So over the course of the pandemic through December of 2021, the great states of Minnesota losing about 109,000 jobs or 3.6% of its pre-existing base of employment has yet to reappear. So again, amazing that there will be such a shortage of workers given the fact that we're down so many jobs across the country. Now, you can see the number one sector losing jobs in Minnesota is surprisingly health services, education health services, but most of the job loss is in health services there. You say, Anirban, how's that possible? We're in the midst of a pandemic. Nurses have been so busy. That's true. But what happened is elective surgeries were canceled. People have not gone to their dentist for the routine checkup, right? Because of fear of infection, all these kinds of things, people staying at home. And so this result prevails. You can see one sector that's added jobs is construction. And I'll talk more about the housing market and real estate later on, but construction has been a major source of job growth in a fair number of communities in America, including in particular in the American Midwest. You see job growth in construction, for instance, in Pennsylvania and some other states as well. Minneapolis Metro. Minneapolis metropolitan area, February 2020 versus December of 2021. Minneapolis Metro losing 74,000 jobs over the course of the pandemic. Today, 3.7% of job totals. Number one sector losing jobs, mimicking the nation, leisure and hospitality. Again, that's your hotel and restaurant worker. And of course, Minneapolis famously is home to the Mall of America. But this has been a challenging time for brick and mortar retail. More on that in a moment around the country. You can see construction adding jobs, the supply chain adding jobs, and manufacturing adding jobs. And I know that with respect to Ohio, the great state of Ohio, a lot of focus was on Cincinnati yesterday. But the big winner recently in Ohio was not Cincinnati so much, especially yesterday, but Columbus, because Intel announced that it was going to invest $20 billion to construct 2 chip-making factories in the Columbus area. And this is, I think, symptomatic of the fact that many American manufacturers are trying to bring more of their supply chain back home. And of course, Minneapolis, home to companies like Cargill and General Mills, 3M, and many others, plays a special role in American industry. Cargill is the largest privately held company in America. So a behemoth in terms of food, the food industry, as everyone knows. So in any case, I think the long-term future for Minneapolis manufacturing, and in fact, Midwestern manufacturing is very positive. And I think you will see more supply chain brought back to the great American heartland going forward. Now, this provides you some regional data. This is employment growth for the 25 largest metropolitan areas, again, for that pandemic period, February 2020 through December of 2021. Again, only the national data are available for January. So it's largely a mistitled slide. There's not much evidence of job growth here. But there are a handful of metropolitan areas that have added jobs during the pandemic. At number 1, Dallas. Now, who's the governor of Texas? It's Greg Abbott. Greg Abbott was one of these governors very aggressive in keeping a state economy open during the worst of the crisis as much as possible. You also see some of the things with respect to some of the Minnesota neighbors, South Dakota, Iowa, so on and so forth, very aggressive in keeping their state's economy open. At number 2, those governors. At number 2, Phoenix, the governor there is Doug Ducey. Doug Ducey, again, one of these governors very aggressive in keeping the state's economy open. At number 3, Tampa, that's Governor Ron DeSantis of Florida. Some of you might be in Florida right now, probably hiding out from the winter in Naples, for instance. Ron DeSantis, again, one of these governors very aggressive in keeping the state's economy open. Cherry picking now at number 5, Atlanta, that's Governor Brian Kemp. Brian Kemp was the first governor of the country to reopen his economy. So some governors were focused on keeping the economy open, hewing as close to normalcy as possible. Other governors were more focused on the public health implications of COVID-19. So if you look at the bottom of the second column here, you see Orlando. Say, Anirban, sir, what is your narrative here? Orlando's in Florida. That's Governor Ron DeSantis. Well, of course, the structure of economies matters too. And Orlando is about visitation. It's about getting on a plane and going to a crowded theme park. And that would not tend to fare well, that kind of economy, during the midst of a pandemic. So Disney has not been operating at full capacity for much of the pandemic, that kind of thing. At number 24, also at number 24, New York Metro. So, Governor Kathy Hochul, she's the governor these days of New York, but for much of this period, it was Governor Andrew Cuomo. He and his counterpart, Phil Murphy in New Jersey, Phil Murphy just starting his second term, very aggressive in keeping that regional economy shut down. And New York City, of course, was an early stage viral epicenter. They got walloped early on So did Detroit, for instance, other parts of the country. So some governors were more focused on the public health impacts. It's not for me to say which approach was better. That's for you to decide. So the keep it open approach or the shut it down approach and try to minimize infection. Again, but I'm simply suggesting that such policymaking had major economic implications. They might say to me, Anirban, sir, these decisions were made, for instance, in March and April of 2020, for instance, right? We are now in February of 2022. Why does this matter still? Here's why. Well, I'm reminded of the parable of Humpty Dumpty. Perhaps you've heard of this story. So Humpty Dumpty was an egg, but an egg with special characteristics, namely legs, arms, and a face. Now, one day Humpty Dumpty is sitting on a wall, minding his own business, by the way, public property, so no trespass there. And somebody in a very mean spirit pushes him off that wall. Okay? Now he's next, so he breaks. Now all the king's horses and all the king's men try to put Humpty Dumpty back together again. I'm not sure why the horses were there. They have no arms or hands, but even the men could not do it. And my point is, the economy is an egg, and it got broken. But it was less broken in certain communities that shut down less aggressively than others. And so it's been very difficult to reconstitute that egg, particularly in places where we lost a lot of businesses, a lot of employees were dislocated because the shutdowns were more aggressive. Again, I'm not criticizing that. I'm simply suggesting that there's a correlation between the aggressiveness of shutdowns. You can see Minneapolis here at number 20, for instance, and the pace of bounce back from the initial phases of recovery. Now, this next slide will tell a somewhat different story. This is unemployment for the same 25 large metropolitan areas. Now, again, lots of things shape these data, but it's probably not completely coincidental that in December of 2021, the lowest unemployment rate is in Brian Kemp's Atlanta, Georgia. The highest is in Gavin Newsom's Los Angeles, California. Who is the governor of California? It's the wickedly handsome Gavin Newsom. Himself could be a Hollywood actor. I'm not sure why he's not, because he's not that powerful of a governor. Utterly gorgeous gentleman, but very aggressive in keeping that state's economy shut down. In fact, was the last governor of the country to reopen his economy. Now, Minneapolis, look at that low rate of unemployment. And one of the questions you have to ask is, where do we find the workers to fuel the ongoing recovery? Atlanta, 2.3%, Phoenix, 2.4%, Minneapolis down to 2.5%. So again, one of the aspects of inflation that's going to be with us through 2022 is wage inflation, because the workers are simply not there and this economy continues to reopen, at least in fits and starts. Okay, enough of that labor market dynamic stuff. And in fact, enough about inflation. Let's talk about something else. Now, you've heard it a million times before that the consumer is about 2/3 of the economy. What they really are, of course, is 2/3 of aggregate demand. So they supply about 2/3 of demand to the economy. Here's a reflection of consumer spending. It's retail sales, monthly retail sales back to the year 2000. But I'll focus on the right side of the slide. So there was a moment of weakness in retail. And you'll remember that in 2020, a number of major retailers went bankrupt. Pier 1 Imports goes bankrupt, True Religion goes bankrupt, JCPenney, J. Crew, Neiman Marcus, GNC, Francesca's Guitar Center, Lord & Taylor, they all go bankrupt. And there was a moment of weakness. If you look at the slide on the right, that moment of weakness begins in February of 2020. Now, by February of 2020, we hadn't shut down the economy, but we had heard about COVID-19. So some people began to withdraw from the economy, at least partially, not going out as much, not shopping as much, and then things fall off the table in March and April. So a lot of damage was done. But by June of 2020, retail sales are above their pre-recession peak, and they have been taking off generally ever since. So this has actually been a very good period for retail, as it turns out. And some categories have, of course, done better than others. This is U.S. retail sales by type of business. Again, that February 2020 versus December 2021 period, these horizontal bars represent the percentage growth in retail spending in each of these categories over the course of the pandemic through December of last year. So total retail sales were up 19%, and they were up in the sporting goods, hobby book, and music stores category 35%. Why? That's a brick and mortar category. What's that about? That's about the sale of Peloton bikes and other exercise equipment. If people couldn't go to the gym, they brought the gym into their residence, which is one of the many reasons, of course, they want more space in their apartments and their homes, because they want room for that home office, they want room for the home gym. They're spending more time at home, whether if it's just watching Netflix, so they just want more space. So people bought the Peloton bike, they bought that stair stepper, they bought the rowing machine, they bought the mirror thing I don't fully understand. And so this result flows. Gasoline stations, oh, this is interesting. That's number 2. Why is it interesting? Because a lot of people are working from home, so they're not commuting. Now, some of this, of course, is driven by the fact that gasoline prices recently rose 50% on a year-over-year basis, right? They rose 50% in a year. So that's part of the sales story, but it's not all. People, as it turns out, are doing lots of driving. Don't you see a lot of traffic out there? Why should there be so much traffic if people are working from home in such large numbers? Right? So they're saying we're working remotely. Maybe they're just remotely. And so that's an interesting phenomenon. I think at the very bottom, you see the worst performers. It's electronics and appliance stores. You say, Anirban, how is that possible? I would have thought that given that we're spending so much time at home, that people would be, buying a lot of electronics or wanting a lot of electronics and appliance stores. Oh yeah, demand is high. The problem has been a lack of computer chips, and therefore a lack of appliances and Sony PlayStation 5s and other forms of inventory. And then above that, the second worst performing category, food services and drinking places. And by the way, this is not adjusted for inflation. So food service and drinking places is a fancy way of saying restaurants and bars. So most of you would call this restaurants and bars. We economists call this food services and drinking places, which is one of the many reasons many of us have never been on a date. Now, this is consumer demand, of course. There are other forms of demand. So because businesses can't find enough workers in many instances, what are they turning to? Equipment, to try to bolster productivity, the productivity of the people they have on their staffs. Now, this comes out of the gross domestic product data, non-residential fixed investment in equipment, and you can see over the course of the last few quarters, a real increase in equipment purchases. Now, it would be even greater, but again, not enough computer chips, and so a lot of this equipment is not available to be purchased. But this should be another source of growth in the US economy going forward. And then, of course, government has been spending a lot of money. So this reflects federal government expenditures. Now, one of the things you will hear from economists and others is that in 2022, the federal government will become a bit of a drag on the economy because they're not going to spend as much in the economy in 2022 as they did in 2020 or 2021. West Virginia Senator Joe Manchin had something to do with that, as did Arizona Senator Kristen Sinema. In any case, but one of the things that will countervail that, at least partially, is stepped up state and local government outlays, because in many cases, state and local governments are flush with cash, in part because of the package signed by Joe Biden on March 11th of last year, the American Rescue Plan Act of 2021, which, among other things, sends ultimately $350 billion to state and local governments. So the demand side, in any case, of the economy is quite strong. Now, let me talk about another aspect of that, something in which you might have interest, whether you're in Minnesota or Florida, wherever you are right now, which is, of course, real estate. So let's talk about that. So the Federal Reserve, of course, we talked about the inflationary story, but their intentions were good. And what was their intention? To add liquidity to financial markets, to keep the economy going, to drive down the cost of capital, including by driving down interest rates. Here I'm showing you two interest rates of interest. I'm showing you the 50-year fixed mortgage rate in red and the 30-year fixed mortgage rate in blue. Now, it's true mortgage rates have been rising recently, but based on historic standards, and this is through February 10th, so this is just as of a couple of days ago, or 4 days ago, mortgage rates remain near historic lows. Now, as I say, behavioral changes, desire of social distance, low mortgage rates, desire for more space for home offices and home gyms, just spending more time at home, has induced a lot of people to want to find a home to purchase, right? Home ownership has gone up during the pandemic, and so too have home prices as a result of all that demand. This is the S&P Case-Shiller U.S. National Home Price Index. And you can see your home prices have been rocketing higher during the pandemic. And I've not been surprised by the fact that they have risen, by the way. I have been, I'm speaking honestly, I've been surprised by how much they have risen. And maybe you have also been surprised by this. And many people will tell you, this is a straight up bubble. This is a housing bubble. This is 03, 04, 05 all over again. Not so fast. I don't think it is. Remember 03, 04, and 05? You might remember at that time, we induced a lot of artificial demand through poor lending standards. So that was your subprime mortgages, your no document loans. And then we supplied to that artificially induced demand. And so that house of cards had to tumble. This time is different. Because if you look at the inventory of unsold homes, it's fallen dramatically during the course of the pandemic. The issue here, if there is disequilibrium in the housing market, it's not because we have too much supply of housing, it's because we have too little housing available to rent and to purchase, particularly to purchase. So you've seen that apartment rents have been skyrocketing as well. Well, that's because many young families can't find a house that they can afford, so they end up leasing for 2 or 3 more years, and that drives up occupancy and rents, because in many cases, those young families also want space for home offices, home gyms, space for their pets, maybe even kids if they have them, but many of them don't. They treat them pets like their kids. In any case, the point is that's driven up rents and home prices, the scarcity. And the scarcity has persisted. One of the things I want to do for you as I move toward the tail end of this presentation, which has about maybe 7 or 8 more minutes in it, and then we can go to Q&A, because I want to show you a number of leading economic indicators. Here's one. This is U.S. residential building permits. And it's a leading indicator because if you're a builder, you've got to pull a permit before you build. So the segment I'll focus on here is the red segment that relates to the construction of single unit structures. Now look what we're building in terms of magnitude back in 03, 04, and 05. We're building a ton of single family units. And again, during a period when demand was artificially inflated. But then for many years, with the financial crisis of 2008 and the foreclosure crisis that lingers thereafter for a number of years, we haven't built many single family homes. Even recently, even with all this unmet demand, builders have not been pulling a lot of permits. Why is that? 2-word answer, softwood lumber. But it's not just softwood lumber. Softwood lumber gets all the ink, all the press, but it's gypsum, glass, copper, concrete slab, workers. Anything that goes in the construction of a new home has become more expensive during the pandemic. So a lot of builders find that they cannot supply to price points that would be comfortable for their would-be buyers. So this lack of available housing persists. And so I don't feel it's a speculative bubble. Oh, it's true that at some point home prices might fall. That's true, but only if mortgage rates take off. But as long as mortgage rates remain relatively well behaved, and they are going to rise going forward, but as long as they remain relatively competitive vis-a-vis history, I think that even though the appreciation of homes won't be as astounding as it has been, I would not expect a price collapse. And some people might tell you, well, the price is going to collapse. I don't see that based on the lack of inventory of unsold homes. Now, there are some segments, real estate segments, in which there is in fact too much supply. For instance, this is the U.S. office vacancy rate. So yes, the economy, in terms of gross domestic product, by the second quarter of 2021, gross domestic product in this country was above its pre-recession tally. But you wouldn't know that based on office vacancy. And again, part of this is remote work. A lot of Americans will prefer to work remotely. And a lot of employers are saying to their employees, you know what, if you want to work remotely, we'll allow you to do that at least several days a week. Right? The notion that you get into traffic 5 days a week, rush hour traffic, going to work and coming back, 10 times a week being stuck in rush hour traffic, many people are saying, no, I'm not going to do that. You'll see, I often get questions from audiences when I'm in person, for instance, Anirban, when is the 4-day work week coming? Well, I think for some employees, it's coming pretty soon, as it turns out. Anything to try to hold on to enough personnel. This is retail space vacancy in malls. So, again, Neiman Marcus, J. Crew, J.C. Penney, True Religion, Francesca's, Guitar Center. So a lot of those retailers close stores in malls along with other retailers. So that's where you see the real pop in vacancy. None of this, by the way, is good for commercial real estate or construction. And then hotel occupancy is here. And hotel occupancy has bounced back since the worst of the pandemic in 2020, but it's nowhere near where it was before. And as it turns out, in America, we built a ton of hotel rooms just before this pandemic. And now here we are. We're having a meeting. This is a meeting right now. We could be in person. I hope to meet you one day in person, especially if we are doing it in Naples, as it turns out. But here we are. Online, it's fine. You're seeing the data. I'm enjoying myself. I mean, am I wearing pants? I'm not telling. But the point is, we are having a meeting, and so this would tend to affect, business travel. So, okay, enough of that. Let's go to the forecast now, because I really do want to get to Q&A. I really want to know what you're interested in talking about this morning / now afternoon. So, this is non-residential investment in structures. It's just, again, reiterating what I've said, which is that commercial construction is weak. So this is building construction. Investment structures is building construction. You don't see any recovery there, right? And I don't think that will be a segment that's going to perform fairly or reasonably well over the course of the foreseeable future. I talk to a lot of commercial real estate brokers, and they will say to me things like, well, this remote work thing is not a big deal. They're trying to convince themselves. It is a big deal, right? So I hope you have enjoyed this James Bond theme presentation. Just a few more slides to go for me to lay out the forecast. My name is Anirban. And as I said, I promised you some leading economic indicators. So here's one. This is from the University of Michigan. This is their index of consumer sentiment. Where is the consumer in America right now psychologically? In the dumps. So look at the last reading here. It's a pandemic low. So we've got vaccinations. Omicron is fading. We've got fewer hospitalizations, and Americans are miserable. And what's making them miserable? Inflation, more than any other factor. Now, there might be other factors at work, right? So Russians trying to invade Ukraine, whatever it is that they're thinking about, they're not happy. And they're not alone. This is from the National Federation of Independent Business. This is the Index of Small Business Optimism. Question, Small Business America, and again, many of you are small business people. I am myself, I own my own small business. Question, Small Business America, is it a good time to expand your business over the next 3 months? In January of this year, only 9% of small business operators said yes. They're facing inflation. They can't find workers, right? And what's the issue here? We have this unbalanced economy where supply is not rising up to meet demand, which is, again, inflationary and frustrating. And if small businesses are not confident, they're not going to expand capacity rapidly enough for supply to quickly catch up with demand. And again, one of the reasons to think that inflation is going to linger in 2022. Now, consumers are telling us, oh, we're miserable, right? So sometimes these leading indicators are not that useful because consumers tell us all the time, we're miserable, we're very sad, country's going the wrong direction, but I can't talk to you any longer because I'm going shopping. This is US manufacturers' new orders for consumer goods. So the consumer is saying on the one hand, I'm miserable, I'm so sad, and then they're shopping because you can see your orders are rising. And ultimately, orders translate into production and distribution. It's a positive leading indicator for the economy. Here's something else to think about. So we've been talking about all these supply chain disruptions, all these ships waiting outside the port of Los Angeles or the port of Savannah, Georgia to unload. And I'm not suggesting to you that supply chain disruptions have disappeared, but they may be dissipating. This is a survey from the Philadelphia Federal Reserve Bank. This blue line here reflects expected delivery times. And what you see if you look at the right edge of this slide is that delivery times, or expected delivery times, are falling. That the notion is that some of these supply chain issues are beginning to dissipate. And I think that's part of the growth story as well for 2022. So more labor market participation and fewer supply chain disruptions, I think, add up ultimately to economic growth. And people will still be miserable the entire time, by the way, even as the economy is growing. That's what's been happening, right? We've had this pretty strong recovery. During the fourth quarter of last year, the US economy grew 6.9%, but you wouldn't know it based on American attitudes because, as I say, psychologically, they're down in the dumps. But I still think, based on this index and other leading indicators, this is from the Conference Board, US Leading Economic Index, leading indicators are positive. We're going to grow in 2022. Now, I'm not speaking of 2023. I only speak 1 year at a time. I only give a 1 year forecast because, I'd like to bill you again, right? But I'm a small business owner, I'm shameless. But 2022, it seems to me, is shaping out to be a year of growth. I get it, market volatility, all kinds of things to complain about, including inflation. But final slide, you only forecast twice. So you forecast at the beginning of the year, and then you forecast for the end of the year once you know what's happened, and you tell people that I had predicted correctly what had happened because you hope that they forgot what you said earlier in the year. So this will be a year of growth. But the economy will remain unbalanced with supply struggling to keep up with demand. And along with rising wages amidst the Great Resignation, that translates into higher than average economy-wide inflation in 2022. Yes, I'm an economist, so I am forecasting interest rates to increase. You ask any economist at any moment in economic history, will interest rates go up? We're going to say yes. We've been doing that for 40 years. We're often wrong. Typically, we've been wrong. It doesn't stop us from continuing to forecast that way, but this year we're right. Because we know the Federal Reserve is going to tighten monetary policy, and we can already see that some of these interest rates, like the yield on the 10-year Treasury, have popped. Back in July of 2020, the interest rate on a 10-year Treasury was 0.55%. This morning, we're back up to 2.02%. And then finally, beware of rapid declines in commodity and asset prices at some point in 2022. What goes up can come down. And we've seen some of that market volatility already, but watch out for prices of steel, aluminum, copper, some of these other oil. Some of these other prices that are really elevated. At some point later this year, you could see a bit of the bottom fall out of those prices. So if you're long those assets, you might want to think about that. And with that, let's go to Q&A.
Yeah, thank you, Anirban. That was great. We've got a number of questions here. Maybe I'll try my best to bunch them if I can and let you speak to a couple of different themes that seem to be presenting themselves. A number of questions around the Federal Reserve. I think there's some sentiment out there that says, historically they've tended to overdo it when it comes to rates, and that's ultimately resulted in a recession. Do you think that's a significant risk, and how and when could that potentially play out?
Yes, so Nathan asked that question. Lenny asked a question that's similar to that. Yes, gentlemen, and also all the listeners on this webinar, thanks for being with us, by the way. Thanks to Boulay Financial Advisors for making this possible. But yes, it's a real risk because the Federal Reserve is behind the curve. So I'm not saying that anything's going to happen that's Paul Volcker-esque. If people remember the late 70s and early 1980s, when Paul Volcker basically single-handedly, 6'7" Federal Reserve Chairman, tallest Federal Reserve Chairman in American history, tried to squeeze out inflation from the U.S. economy. But they're behind the curve, right? They still have not raised rates even once. And here we are sitting with 7.5% inflation. They thought it was going to be transitory. It wasn't. At least it hasn't been. So the best guess is that they're going to raise rates 4 to 7 times this year. I think there's actually some economists will say 8 times this year. Some people think they're going to raise 50 basis points in March. In fact, right now the markets put a 50-50 odd on that. I still think, despite what the St. Louis Federal Reserve president said last week that shook up the markets, that it's 25 basis points in March. But we shall see. It's very difficult to predict. But yes, as stimulus is increasing the rearview mirror, as we no longer have growth driven by the reopening of the economy, as interest rates, including mortgage rates and other rates, go higher into 2023, for instance, could that create some economic weakness in 2023? Oh, you betcha. As I say, I think 2022 is a year of growth, but beyond 2022, I think there's some real downside risk to the economy.
Maybe a little bit related to that, you had a chart earlier that showed, money supply growing materially over the last year, and yet inflation is just kind of showing up now. The question is being asked, on top of that, the rate of inflation is not in line with the growth rate of money supply. Can you walk us through why that lag exists? And does that imply that the inflation we're seeing today is just sort of the tip of the iceberg?
Yeah, so that lag exists because for a while demand was suppressed, right? What was it suppressed by? So we couldn't get on airplanes, couldn't go to Disney. A lot of people couldn't go to work, right? Didn't want to go out shopping, pre-vaccination. So, a lot of demand could not express itself. And then all of a sudden, Johnson & Johnson, Moderna, and of course, Pfizer, AstraZeneca, others introduced vaccines. All of a sudden, the global economy starts to reopen. And so all of a sudden, demand is starting to express itself, especially because during that period of idleness, a lot of Americans were receiving stimulus payments. Some who were unemployed were receiving $600 a week in federal unemployment benefits early during the pandemic, on top of their state unemployment benefits. 68% of workers who were receiving those federal benefits were making more being unemployed than they were at their previous job. So all of a sudden you had all this bottled up spending power, and then the economy reopens, and all of a sudden this demand shoves itself into the economy. The supply side of the economy is not ready for it. So it was a delay. But now with all that money supply, all that stimulus, all that demand expressing itself, what do you get? You get inflation, especially because we've had waves of virus. So, things would have been better right now on the inflation front, but for Delta and but for Omicron. So I think that's why you've had the lag, is because overlaying all of this has been a pandemic.
Let's shift a little bit, and there's a couple political themes. I think domestically, a question is being asked around your opinion around there's sort of this divide between red states and blue states, and this migration between states. And you talked earlier about the impact or the economy in different states being governed in different ways. Do you see this sort of continuing going forward? Is there anything that sort of slows that migration down, in your opinion?
Yeah, the big migration during the pandemic has not been so much from north to south. That certainly happened. Don't get me wrong. Again, a lot of baby boomers retired earlier than anticipated. And once you retire in a state like Connecticut or New York or Michigan, so on and so forth, it's not unusual for someone to end up in South Carolina or Florida or someplace else. I'm from Maryland. So, I meet a lot of former Marylanders in Naples and Marco Island and Fort Lauderdale and West Palm Beach and so on and so forth. So that's not, and sometimes in southern Delaware, as it turns out. So that's not unusual. But what I really see here as the bigger migration was from cities to suburbs. A lot of people left central cities during the pandemic and moved to the suburbs. Now, part of that is that movement to home ownership, right? Want more space, want bigger units, and typically you have bigger housing units in the suburbs compared to the city. Some of that was because of unrest in certain American cities. Minneapolis comes to mind, but many other cities come to mind along that dimension. And so lots of centrifugal forces pushing people out of cities. The fact that we have remote work, the fact that we have online shopping, the fact that many people are watching Netflix a lot. So I can watch Netflix from San Francisco, but I can also watch it from Fresno. I can watch Netflix from Los Angeles, but I can also watch it from Bakersfield. and my cost of living is lower there. So we've seen a lot of that movement out of very expensive cities into suburbs and then also into less expensive communities. So yes, and I think that some of that migration continues because technology is pushing us further and further away from central cities. If I can work remotely, then do I want to be in a central city? Some people will always want to be in central cities because they love the buzz of that. But others will say, no, I if my employer is in Minneapolis, but I can live, someplace a little less expensive, maybe I'll do that.
Great. A couple questions I want to sneak in before here we let you go, but maybe just talk a little bit. Let's talk about asset classes. And so if you could comment, on maybe where you see we're at in the economic cycle. I think you've touched on this a little bit, but if we think about a rising rate or an inflationary environment, are there some asset classes we should be thinking about? There's questions being asked about real estate and REITs as a deflation or an inflation hedge, and any other thoughts you might have on that specific topic.
Yeah. So if you're going to be in a REIT, I think you don't want to be necessarily in a real estate investment trust that holds legacy office assets, for instance, right, or legacy hotel assets, right, because those valuations will likely be suppressed by ongoing shifts in the economy. But if you have a real estate investment trust that's now buying office buildings that are underutilized at a very low price point because we've had this transformation of the economy, or hotels at a very low price point, or shopping centers at a very low price point because we have these transformations, that's different. If you have a real estate investment trust that's invested in multifamily, if they have really good properties, I would certainly see that as a possible investment vehicle. But at the end of the day, I ask myself this question: look, where are people going to put their money? Bonds are still yielding almost nothing. So I know the 10-year treasury is up to 2.02%, but that's still quite low and nowhere close to inflation. So if you're trying to return something that might get you to an inflation rate of return or better, U.S. equities, right? I mean, now, if you're going to invest in U.S. equities, I would say low beta, great balance sheet, high dividend, those kinds of things. The NASDAQ is up today by 103 points, but as you know, the NASDAQ has been pounded, and the NASDAQ has been especially sensitive to notions that interest rates are going to go up going forward. Right? So, I think, just stock, I don't want to name any particular stock necessarily, but those consumer staples, I think we know what they are. One of them is based in Cincinnati, for instance. I think those are the best bets in terms of preserving wealth during a period of what's going to be, pretty enormous volatility, because rates are going to rise. To the extent that you can get yield from bonds, like say municipal bonds, I'd go for that too. And then certain precious metals like gold and silver, platinum and palladium. I think there's a story to be told there as part of a diversified portfolio. And then, you know what? If you dip your toes into Bitcoin or Ethereum or Litecoin, just with a Coinbase account, I wouldn't put all my savings there. That's for sure. Though some 27-year-olds have. But I think again, that's cryptocurrency is part of a diversified portfolio.
Thank you. Last couple, as if we didn't have enough to worry about, now there's some concerns around, geopolitically with Russia and Ukraine. Maybe from a historical standpoint, can you provide some context on the type of economic disruption we could expect with something like that if there's further developments, knowing that we don't know exactly how that would play out?
The conventional wisdom is if the Russians move on the Ukrainians, then oil prices, which have been in the low 90s, will go to $120 a barrel. And natural gas prices could be even more significantly ratcheted higher. And natural gas prices already are very elevated around the world. And so obviously you're building inflation on top of inflation. You're straining consumers even more. You're further dissipating consumer and business confidence. None of this is good for economic growth. So, somehow somebody's got to figure out a way to give Vladimir Putin a diplomatic win without giving anything to him, so that he's got an out, so that he doesn't have to take these 130,000 troops and put them into operations other than to go back to Moscow or St. Petersburg or wherever they're from. So, we will see if this works diplomatically, but that's the effect. It's not good for the global economy. Every instance is different, but I think in this case, you'd see sharply rising oil prices. And you might remember during the Gulf War of the 1990s, the early 1990s, that was associated with a recessionary period. And part of the reason was we had a shock to the global energy market. Absolutely.
Well, on behalf of Boulay and Boulay Financial Advisors, we want to thank you for your time, Dr. Basu. I think this was enlightening and entertaining, like I mentioned earlier. some of the things we love about our work is that sort of regardless of what's going on in markets or economy, there are always opportunities and ways to make your personal situation better. So if you want to have a conversation about that, or if you have questions about anything you heard today, certainly don't hesitate to reach out to us. You can see our phone number there, 952-893-9320. Just one more reminder, if you are a part of this or even signed up for it, it is being recorded and we will provide that link to everyone as a follow-up. Thank you, Dr. Basu, and best wishes to all on the call.
Likewise. Thank you.